Capitalist Show, a good buddy of mine, one of the top real estate experts in the entire United States. His name is Jason Hartman. Jason, welcome back to the Rebel Capitalist Show.
Thanks, George. It's great to be here and great to talk to you again. I want to first off congratulate you. You are now over 100,000 subscribers, and your great work. It didn't take long for you to be at the top of the heap and get really, really recognized because the word is getting out, and you're teaching a lot of people what's really going on behind the scenes with these out of control central banks and now more than ever, they are out of to infinity and beyond. They've self-proclaimed that that's the policy. So it's crazy. It really is. Yeah.
Well, we're really excited about it. It's been fun. I've got some great editors. I've got to give them most of the credit, but we think we've got a long way to go. Like I said, when we did the little live stream for the 100,000, the next goal is to get to 1 million subscribers, and with the team I have, I think we can do it if I don't screw things up too badly. So
you're so humble. Come on, your content is fantastic. You have a good team for sure, and the editing is great, the production's great, but your content is just second to none. So.
All right,
thanks for doing it.
Speaking of that content, let's dive right into it here because as most people know, I'm in Medellin. I'm outside the United States, especially now with the cerveza sickness. I haven't been back to the U.S. in a long time. And you are the real estate guy. You've got your finger on the pulse of everything that's going on. And a lot of my viewers are very interested in the United States real estate market for obvious reasons. So I want to just kind of hand it over to you to give us an update as to what's going on the broad market, maybe specific markets, the mortgage market, just all, and interest rates for sure.
Absolutely, absolutely. Well, looking at a macro view maybe first, retail spending has pretty much collapsed in an economy where 70% of the S&P 500 is consumer spending. This is hugely significant. Obviously, you've been profiling the oil market on your show. This is all connected with real estate in a huge, huge way. So we would be remiss if we didn't talk about how retail spending saw its steepest decline in 7 decades. It just plunged. It's unbelievable what's happened. But the necessities held good. Obviously people still need groceries and toilet paper. So huge spending there, obviously. But it goes to show you that the basic necessities are the key, and that's what I want to stress about real estate. It's really a tale of 3 markets: linear markets, cyclical markets, hybrid markets. And with real estate, necessity housing is going to do quite well. Our business is pretty much unchanged. Investors are still buying properties at a rapid clip. Just looking at our last month's performance, I've got to say, and hopefully this will continue, but business has been fantastic. People are attending our webinars, they are buying properties, and a few are concerned and scared and have fallen out. I actually did not expect it to be this good. It's beaten my expectations. So good bread and butter housing. If you live in that type of property, you're in good shape. The basic entry-level type housing below the median price in whatever your given market is, that's still very much in need. But George, the high-end markets, another story completely. And those
Jason,
are the expenses.
Just to clarify for the viewer, how would they go about finding out what the average price of a house is in their market? Is there some website or some charts or something that you could refer them to, or maybe on your website?
Yeah, there are lots of charts about that. And remember, when you look at the United States real estate market, the Case-Shiller index, the most widely quoted, only profiles, at least their main index, the one that's talked about, is 20 markets. And 15 of those 20 markets, George, are cyclical markets, meaning they're high-priced markets, and they're markets that go up and down like a roller coaster if you're looking at a chart. They're markets we would not recommend, that we would not invest in. So, three-quarters of that, cyclical markets. The linear markets, which we like, the boring markets, the ones nobody talks about, those are the vast majority of the world and of the country geographically, but they're not talked about very much. So
Mhm.
when you look at markets like Little Rock, Memphis, Indianapolis, Atlanta, these markets are quite solid, and they're holding just fine, and housing affordability has increased dramatically a lot. So you want to be below the median price in any given market. As for where to find that, there are tons of charts. Unemployment skyrocketed. Last month, we saw incredible stats we've never seen before. It took kind of a few weeks to get to where we think we will get past where most of those jobless claims, and I think most of them are behind us now. So the big piece of that has now been recorded, and we'll continue to see further claims, but most of them have now been documented, and we kind of know how bad it's going to be. And we've seen stimulus maximus, as we've talked about. It's just crazy. But one thing that concerns me greatly here is inequality. A lot of people have been talking about that long before we had a pandemic. And I think it is going to be exacerbated dramatically by this, because the digital workers, the knowledge workers, they're mostly working and thriving, or at least surviving
Right.
through this phase. They can work at home, they can work remotely, but the lower tier of the spectrum mostly cannot work, and they will be very hard hit. So that again tells us that basic necessity level, or what's sometimes referred to as workforce housing, is going to fare pretty darn well, and demand will increase through this situation.
But
So yeah.
if there's going to be, okay, so just unpacking that for a moment. So we've got high unemployment rate. We've got more people that have the ability to work from home doing so. But we've got the heart. So the inequality factor would be those people who aren't willing to work at home, maybe the more blue collar, they're really struggling. But
Right.
aren't those people the individuals that would be purchasing those basic homes?
Well, they might be purchasing them, but we don't really deal with the purchase side of the market very
Oh,
much.
you're
We deal
looking at
with
the
the
rent.
rental side. So there a lot of rental demand
Okay.
for that type of housing. That's what we're really interested in. Our investors buy them, and a lot of those are knowledge workers who are not out of work. So they keep investing. But when you think of the rental market, you're going to catch a lot of people moving down the tier. As far as the sales, we don't know yet what percentage, and this data will be out soon, but there's quite a lag in real estate. How many of the purchases going on now are renters versus owner-occupied homeowners? So that again, we have to wait for those stats. We don't have them yet. It's
Okay.
too early to tell. But just my opinion is, it's moving more toward the investor side of the equation, more
Right.
investor activity.
But you're still seeing some substantial demand for sales. So
Oh
to
yeah.
even though we're having the economy is really struggling, it's, I mean, what's going through my mind is, number one, for real estate, it takes it a long time to move. It takes it a long time to go up. It takes it a long time to go down. If I just think back to 2006 when we hit the peak, it didn't bottom out until 2012. So I'm looking at all of these cross currents, and
Right.
I'm trying to decide, could we have if prices go down in the United States, could they go down a lot faster, or are there so many of these cross currents that are pushing prices up that it'll kind of stabilize it, and we'll have a gradual downward climb, or maybe a gradual uptrend in housing prices because of a lack of supply? How do you see all those cross currents playing out? And like, what I'm thinking about is the unemployment rate. I'm thinking about, so how does that affect rents and prices? And then also, how then you've got to ask yourself, okay, is it a linear cyclical or one of these hybrid markets that you're referring to? But then also, you've got the investors back in 2012, like BlackRock, that just bought up everything.
Right.
So are they going to potentially liquidate, and how does that affect the game? And then also with Airbnb, you had all these guys go out and leverage up to buy 40 or 50 properties. And how does that play into the mix? I mean, this is
There's,
like one of the best
yeah.
macro puzzles of all time.
If you expressed it perfectly well, it is a macro puzzle, and there's even more distortions and cross currents than you mentioned. Of course,
Oh yeah,
there's the forbearance programs for mortgage
right.
payments. There's the rent strikes that are going on in properties where renters are getting together and forming unions, mutinies, strikes against the landlords. That's why we like single family homes so much better than apartment complexes, because our renters aren't talking to each other. Okay. And they can't form a strike because they're all dispersed individually, right? And a lot of cross currents, no question. And when the government and the central banks and that's just any government, any central bank, not just the US Fed or the US government, when they keep interfering in the market, you have no price discovery
Right,
because they
right.
just won't let it happen. They won't, we have become so intolerant of any pain whatsoever that, it's just big government, Uncle Sam to the rescue. So hard to tell, hard to answer that question. But for my bet, a long time ago, George, I was saying way before the pandemic, this was many years ago, I was saying Airbnb has not been through a recession.
Mm,
Okay, so be careful. And then about a year and a half ago, I was on a radio show in Georgia. I was doing the interview, and I remember saying on that radio show that I'm going to create a new commandment. I have all these commandments for successful
yeah,
investing.
yeah.
We're up to 22 now, and of the 10 is now 22. And commandment number 21 at that time I said was, "Thou shalt avoid manias." Thou shalt avoid manias, because Airbnb was a mania. And, I just never really bought into it in any significant way. It's taking vacations is optional. Okay. That's not a requirement for human life. And as soon as the economy hits the skids, that optionality is going to go away. People aren't going to be able to afford vacations. But now with the pandemic, it's even worse because everybody's afraid to get on an airplane. Everybody's afraid to, stay in someone else's house that might have germs and viruses, right? So it's a bigger problem than it was. And if you look at what's going on with the Airbnb market, it has just collapsed, collapsed, collapsed. Now, that said, I do think that as tourism comes back a little bit, the cruises and the airlines will be the last component of tourism to come back, because those are super danger zones. Okay.
Right.
There's no way you can distance in an airplane, and you can't on a cruise ship. But if people can afford to and want to take some kind of vacation and have a getaway, Airbnb markets where people can drive to them and have a truly different experience than they have at home will actually benefit from the decline in airline travel and cruise ship travel. Okay. So the destination oriented Airbnbs where you have to get on a plane to go to them, that's bad. Okay, those are going to suffer greatly. Cruise ships suffer greatly, but some of the benefit will accrue to sort of localized road trip oriented Airbnb and resort vacations where people can have a different experience, okay, and get away, so to speak, without getting on an airplane or a cruise ship. Okay,
Yeah.
so that's kind of a distinction. So we have one Airbnb market in our network for short-term rentals, which is St. Augustine, Florida.
Hmm.
And you can have a very legitimately different life experience driving from Atlanta or Orlando to St. Augustine. That is a real vacation for you. And you don't have to get on a plane. You don't have to get on a cruise ship or anything like that. So those are actually still doing pretty well. We've seen a little bit of movement. We've seen bookings become longer and fewer of these short-term getaway bookings, longer booking periods. So it's kind of interesting. You did ask about Airbnb, so I wanted to mention that. But on the flip side of the Airbnb market, and this is important to the cyclical market, real estate, and the luxury real estate market, lots of people bought and leased expensive high-end homes to put them on the short-term rental market, and those are just collapsing like crazy.
Right.
That's just a
Yeah, because they
bloodbath.
could
It's
get the
terrible.
numbers to make sense. If your
Yeah,
RV ratio is 2 or 3 because you're renting it out nightly
yeah,
as opposed to monthly, you can take what would otherwise be a property that makes no sense whatsoever
right,
from the
right.
standpoint
It
of the
would never,
numbers,
yeah,
and you can turn it into something that might make sense and just barely eke out that positive cash flow. But
right.
boy, if you can't rent that out nightly,
Oh, yeah.
you got big problems.
And let me tell you something, folks. Some people rented those properties and did what I call rental arbitrage. Now
Yeah.
they are defaulting on their leases. So the landlord now doesn't know what to do. And the landlord is probably in a temporary forbearance program with their lender now, or at least they're thinking about asking for it. And they're going to start defaulting, and the foreclosure rate on those luxury properties is going to skyrocket. Okay, that's my prediction. It's still too early. We haven't seen that in the statistics, but I'll predict that. Now, to add insult to injury, as the saying goes, it's even worse if you're in a high density living environment. Okay, so if that short term rental property was in a big city, if
Like
it
San
was
Francisco, New York, something like
yeah,
that.
yeah. San Francisco, New York, Vegas. And I don't care whether it's Airbnb is legal or not in those markets because they vary, but people have been doing it anyway, okay, regardless. Okay. So the market exists. And if you've got a luxury condo in Toronto, Montreal, Vancouver, New York, San Francisco, downtown Seattle, downtown San Diego, downtown LA, any of these markets, Chicago, Miami, whatever, those are just going to collapse, George.
Mm.
And there are going to be a lot of lease defaults, foreclosures. It's going to get ugly, and it's going to be ugly for a while in that market. See, that's the thing. I'm so glad you pointed out to your viewers and your listeners, George, is that you can never talk about the real estate market as one singular entity. It's always the tale of at least three markets. And now we normally would say linear, cyclical, and hybrid, but we've also got to add high density versus low density.
Mm.
Okay, that's another new distinction we've got to add to that. Go ahead.
Well, I was going to ask you how long you're talking about prices crashing in these markets that are high density with these luxury condos or apartments. How long I mean, you've been doing this for so long, you got so much experience, you've seen these cycles play out over and
Right.
over and
But
over
not
again.
like this one.
Yeah. But
This is
how
different.
long does that typically take, Jason, for that cycle to happen, from it to go like let's say condos in Toronto or New York or San Francisco? How long does it take them to go down in price? Does it happen quickly in a few months, or does it take years?
It takes a while, and that's a great question, George. And the thing that determines that question is the capitalist phenomenon of price discovery. Okay. When you have price discovery or market clearing, that's when the cycle recovers. So here's why I can't answer that question. First of all, broadly, real estate moves much more slowly than the stock market or the commodities market. Okay, so it's slower than that. But how long does it take? Well, it depends on the foreclosure laws
Right,
in that given market. And
right,
they vary state by state. And they even, to a lesser degree, vary city by city or county by county. Because, for example, in California, my former home state, the Socialist Republic of California, as I like to call it, in the Socialist Republic of California, the foreclosure laws are actually pretty favorable to lenders. Technically, you can have someone out of your property who isn't paying you within 111 days. Okay. There's a 90-day period where they can redeem and catch up on their payments, and then another 21-day period where they have to completely repay your loan in order to keep the property. But it's almost irrelevant because it never happens. That's the technical law, but the political climate is such that they make it hard to foreclose. And if you can't foreclose and sell that property at auction, you don't have any price
Yeah.
discovery.
And they
Now it
might
gets,
bail them out. The government might bail everybody
yeah,
out.
yeah, that's the distortion. It's very hard to tell. Now, in places like Florida, where I live now, and New York, where you have the foreclosure system where people have to go and basically sue somebody to foreclose on them. Okay. That system takes much longer. And, last time during the Great Recession or the global financial crisis, we saw people in Florida and New York and Illinois where, they're living in their house for free for 2 or 3 years. They haven't made a payment. And you
Yeah.
have no market clearing. You have no price discovery. It's a mess. The best thing you can have is a quick system where you can get these people out, put a new borrower in there that is paying, have price discovery, and the market will heal very quickly. But when the government makes it hard to do that, it's just a long, drawn out, painful process.
You know what just came to mind right there? The depression of 1920 and 21 compared to the depression of the 1930s.
Right. Yeah. Yeah. And you know a lot about that little depression nobody talks about. The early 20s did have a depression.
That's where
And
they
and
let the market clear. It's
right.
the exact same as you just
Yeah.
outlined with your real estate example, where you've got one state where they say, let's just rip the Band-Aid off,
Mhm.
and you get that price discovery right away. You get kind of a V-shaped recovery,
Right.
usually.
Yeah.
And then you've got the other states that just make it slow. They draw it out. You've got all this red tape, bureaucracy. You get the court system involved, and it just drags on and on and on and on. And at the end of the day, it might be better for the person living in the property, but for society as a whole, it's
It's
a lot
worse.
worse.
Yeah.
And it's exact same thing happened in the 1920s, early 1920s, where they just ripped the Band-Aid off, price discovery, boom, V shape, right back up.
Yep.
And then, and also, I was looking at some charts just off on a tangent here yesterday for deflation. And just, I would challenge any of the viewers right now to look up a chart of deflation going back to the year 1900 or even further back if you can find one. And you'll notice that the deflation of 1920 and 21 was worse. It was worse than the initial deflation of the early 1930s. It's just the 1930s, the government got involved, red tape, bureaucracy, it drags on and on and on, where again, going back to the early 1920s, they ripped the Band-Aid off, price discovery, boom, V-shape, you're good to go.
Absolutely. Now, just to kind of wrap maybe this part of our discussion up, um, so listeners have a reference. Let me give it a name. It's judicial foreclosure or non-judicial foreclosure.
Okay.
And the judicial, as the name would imply, means you have to go to court, and it's a lawsuit. You have to sue the borrower for foreclosure. That's basically a judicial. A non-judicial is the faster kind where you don't have to go to court. There's a separate foreclosure process, which of course can, like anything, be disputed in court, but usually it's not, and it doesn't end up in court. Okay.
So I want to go back to the prices, and I know there's so many different markets within the United States, but let's just take it quickly back to 2008, 2009, the crash there, going to when the markets as a whole bottomed out in 2012. If I'm hearing you correctly, the markets where there's this judicial process, the prices probably bottomed out a lot later, and in the markets where they had a non-judicial process, the prices bottomed out a lot faster. So maybe if I'm someone watching this saying, well, I think Jason and George are crazy, I think the market's going to go down a lot faster, they could take it a step further and figure out if their local state is judicial or non-judicial and kind of factor that into the equation.
Yeah, that's a very fair statement, George. Looking at that, it sadly, because even though the laws are there, they don't always follow them, and that's the distortions that we're talking about, right?
Right.
It's just absolutely crazy. But yes, that is an indicator. The other indicator related to that is you want to be investing, and for the last 16 years we've been saying this, so this is not new information. You want to be investing in landlord friendly states,
Right.
and you want to be avoiding tenant friendly states. And almost without exception, you're a state that has got a conservative bent. Even if the governor is a liberal at the time, the overall zeitgeist of the state, like take Texas, for example. Texas is a conservative state historically, right? And California historically is a liberal state, right? And so a liberal state is going to be tenant friendly, and a conservative state is going to be landlord friendly. This is not a hard and fast rule, but generally speaking. And then there are local overlays to these things, but we're just taking a broad view here.
Mhm.
So you want to be in a landlord friendly place, someone who's friendly to your cause as a landlord. So if the tenant's not paying you, you can get them out, have price discovery, as we talked about with foreclosure, and get a new tenant that will pay, right? Yeah.
Yeah. So and I know you're pressed for time, Jason. I appreciate
Yeah. Oh, my
your,
pleasure.
your
Yeah.
generosity here with your time and your experience. But just to wrap things up, what type of advice, if you had to give one piece of advice to just a normal homeowner right now, owner occupant that was just maybe in the market to sell or buy, and then an investor that's considering purchasing or selling, what piece of advice would you give to each one of those individuals?
If you've got a higher end property, meaning and if you're in a cyclical market, and if that property is a high density property requiring elevator usage, I would worry a lot. Okay.
You'd
Those
sell.
properties, I would totally consider selling. And if you're not in a position to sell it, refinance it and pull cash out of it.
Yeah.
One of the other things that's happened just recently is the HELOCs, home equity lines of credit, have been they're just going away. Like Wells Fargo and Chase both did away with them. They won't give you a HELOC loan now.
Mm,
But the difference is you don't necessarily need a HELOC. You can do a complete refinance of the property if you can pull cash out of the property, get control of the equity of that property,
right.
sell it or pull cash out. Okay, those
So that,
properties are going to suffer. If you don't have much equity in that property, by the way, one more thing, don't worry too much because it's your lender's problem more than it is yours.
right.
Okay,
So
so
that would be advice for both groups, either the owner occupant or the investor.
or the investor. Yeah, that applies
Okay.
to both. Okay.
Okay.
If you have an entry level type of property that could be considered workforce housing, if it's in a linear market like most of the country, not the high flying markets, not the expensive markets, a linear market like you'd find on my website at jasonhartman.com, you're probably okay. Okay. Now, the thing I might say, if you own that property free and clear, or if you have a lot of equity in it, also refinance it. But those properties you could probably keep. They're probably in good shape right now. That price point, as we talked about on the last episode, I think I did with you, George. If they're 250,000 or below, you're probably in pretty good shape. Make sure you have a low interest rate, and hang on to the property. You're going to be. I think you're going to sail through this pretty well. I didn't say perfect, because we don't know what's to come, but I think you'll be okay. One other index that's kind of interesting to look at for your listeners is what's called the Mortgage Credit Availability Index.
Mm,
And I know you've been on his show, and I have too. Mark Moss, as someone you know and you follow,
yeah.
he talked about this recently on one of his episodes. But the MCAI is pretty interesting to look at, and one of the things it's telling us is that mortgage credit availability has declined. Okay. That's sort of an overall index of how easy is it to get a mortgage? Okay, that's what it really answers. It's not about interest rates, it's
Right.
about ease of ability to qualify. That index has declined, but where it's really declining is in the jumbo mortgage market, meaning the larger loans. Those vary by area, but a jumbo loan is a larger loan for a more expensive property, and that market is quickly collapsing. The mortgage credit availability index for the conventional or conforming loans, it's also been hurt, but not as badly, even though we're in this climate of incredibly low interest rates. So higher end properties, again, worry. You should be worried. Lower end properties, they're very necessary. You can, if you're renting them, you can catch people coming down the economic ladder. They're probably pretty stable overall. I think you're in pretty good shape.
Yeah. Now, just as far as the jumbo loan, out of curiosity, does the price that one would consider, the banking system considers a quote unquote jumbo loan, does that differ from state to state and city to city based on the cost of living, or is it just a broad, this is what it is?
No, no, no. It does vary. It does vary. In some areas, it'll be like I don't have the numbers offhand. It'll be like 500 and something thousand dollars. Now,
Okay.
remember that's loan amount, not purchase price. Loan amount. Okay, so the purchase price might be 10 or 20% higher than that, right? So that's the loan amount. But in some areas, it goes up into the 700,000s. Okay, so it depends on the area. It does vary.
But I mean, 700,000, even if it was at that level, like in California
Yeah.
and places in LA, I mean, that's still like a starter home.
Well, true, but remember that's not the price of the home, it's the amount of the loan. So if you put $100,000 down, it would be up into the 800s, right? But still, you're right, it's
Yeah.
cheap for those areas. And many people get what they call ultra jumbo or super jumbo loans, where they're borrowing $4 million and putting down 1 million, right? So, you're right.
Yeah,
That
I'm
is.
just thinking, I mean, if the industry as a whole, meaning the banking, the mortgage industry,
Mhm.
is really frowning upon these jumbo loans,
Yeah, they're
and there's a
scared.
lot
They're
higher
worried. Yeah.
percentage of jumbo loans, like in the state of California,
Hmm.
just looking at that, I would say, okay, that's a lot more bearish for California than it would be for um, Kansas
Yes.
or Iowa or something
Right.
like that, where a lot smaller percentage of the overall housing stock were these jumbo loans.
Absolutely right. You nailed it. And not only that, what you'll find is that the entire borrowing relationship in these high flying areas along the California coastline or the expensive northeastern market or South Florida or Seattle, all of these expensive markets, right? These cyclical markets, the borrowing relationship, the borrower versus lender relationship, already long before we ever talked about pandemics and pandemic investing, was tenuous. Those people were scraping to afford those houses in the first place. And now that has become compounded and is even more tenuous with what's going on in the world.
Yeah. All right. Well, we've got to leave it there, Jason. I appreciate it. For all of my viewers, or for any of my viewers who want to find out more about what you do, where should they go?
JasonHartman.com, just my name, JasonHartman.com. And we've got lots of info there. My podcast is available on any of the places where you get your podcast. Just type Jason Hartman and you'll find it. And George, thanks for having me again. Congratulations on eclipsing the 100,000 subscriber mark. Good job.
All right. Thanks, buddy. Can't wait to do it again.